Imagine it's August 1971. You're a mid-level Treasury analyst in Washington, D.C. You've been tracking gold flows out of Fort Knox for months. The numbers don't add up. France has been demanding gold for its dollars. So has Germany. So has Britain. You do the math. At the current rate, the gold vault will be empty within 18 months. You send a memo up the chain. The response you get is silence. 3 days later, President Nixon goes on television. He announces that the United States will temporarily suspend gold convertibility. The word he uses is temporary. That was 54 years ago. The suspension never ended. And in that moment, the entire world's monetary system shifted from being backed by a finite metal to being backed by a promise that has compounded into the largest accumulation of debt in human history. Today, global debt exceeds $315 trillion. That's not a typo. $315 trillion. That figure is nearly 3 times the entire world's annual economic output. Every man, woman, and child on Earth is statistically burdened with over $39,000 of debt they did not personally agree to. This isn't theory. It's documented arithmetic. And the uncomfortable truth is this: there is no plan to pay it back. There never was. Because the system was never designed to be paid back. It was designed to grow indefinitely until it couldn't. Once you understand the architecture, you'll realize we're not approaching a crisis. We're inside one. A slow-motion structural failure that has been building for over 5 decades. And the question no one in power wants to answer is simple. What happens when a debt that can never be repaid finally comes due? Most people think of national debt the way they think of household debt. You borrow money, you pay it back. Maybe with interest. And if you can't pay it back, you go bankrupt, lose your assets, and start over. This mental model is intuitive. It's also dangerously wrong. Governments don't operate like households. They don't have to pay off their debts in a single lifetime. They can borrow from the future indefinitely. They can roll over bonds. They can issue new debt to pay off old debt. And most critically, they control the currency in which the debt is denominated. This gives the public a false sense of security. They assume that because governments have been managing debt for centuries, they must know what they're doing. They assume that because the system hasn't collapsed yet, it won't. They assume that because interest payments are still being made, the situation is under control. But these assumptions ignore the exponential function. Compound interest is not a political opinion. It's mathematics. And when debt compounds faster than the economy grows, you don't just have a problem. You have a countdown. Let me show you the numbers. In 1971, the year Nixon closed the gold window, total U.S. federal debt was approximately $400 billion. Today, it exceeds $36 trillion. That's a 90-fold increase in 54 years. Over the same period, U.S. GDP grew from about $1.2 trillion to just under $28 trillion. That's a 23-fold increase. Debt grew 4 times faster than the economy that's supposed to service it. This is not a uniquely American phenomenon. It's global. Japan's debt to GDP ratio exceeds 260%. Italy is at 144%. France at 112%. The United Kingdom at 101%. Even Germany, long considered the fiscal anchor of Europe, is above 60% and climbing. And these are just the official figures. They don't include unfunded liabilities, pension promises, healthcare obligations, social insurance commitments that will come due as populations age. When you add those, the real figures for most developed nations exceed 400% of GDP. Think about what that means. The promises already made by governments to their citizens cannot be fulfilled with current revenue structures, not without borrowing more, or printing more, or breaking the promises entirely. Those are the only 3 options. None of them are painless. To understand what's actually happening, you need to understand how modern money is created. Most people believe money is printed by governments. This is only partially true. In reality, the vast majority of money in circulation is created by private banks through the act of lending. When a bank issues a mortgage, a car loan, or a business line of credit, it doesn't lend out existing deposits. It creates new money, digitally, out of nothing. This is called credit creation, and it's the engine of the modern financial system. But here's the catch. Every dollar created this way is simultaneously a debt. Someone owes it, with interest. Which means, to create money, you must also create a future obligation that exceeds the original amount. This is the hidden architecture of the system. Money is debt. Debt is money. And for the system to function, debt must constantly expand. If everyone paid off their debts tomorrow, the money supply would collapse. There would be almost no liquidity left in the system. The economy would seize. This creates a terrifying paradox. The system cannot survive without continuous debt expansion. But continuous debt expansion eventually becomes unsustainable. At some point, the interest payments consume so much of the economy that there's nothing left to invest in productive growth. At that point, you're borrowing just to stay in place, and then you're borrowing just to pay the interest on the borrowing. This isn't speculation. It's what's already happening. In fiscal year 2024, the U.S. federal government spent over $1 trillion just on interest payments. That's more than it spent on defense. It's more than it spent on Medicare. And interest rates are no longer at the near zero levels of the 2010s. They've normalized upward, which means that trillion-dollar interest bill is going to grow. The Congressional Budget Office projects that by 2034, annual interest payments will exceed $1.7 trillion. That's assuming no recession, no new wars, no major financial crises, just the baseline trajectory. And this is where the trap becomes visible. To reduce debt, you need to run budget surpluses. But running surpluses requires either raising taxes or cutting spending. Both are politically explosive. Cutting spending in aging societies means cutting pensions, healthcare, or social insurance, which guarantees electoral punishment. Raising taxes aggressively risks capital flight, reduced investment, and economic contraction, which shrinks the tax base and makes the debt ratio worse. So the debt continues to grow, not because politicians are irresponsible, but because the system punishes anyone who tries to stop it. This is not a failure of individuals, it's a failure of design. Let me explain the mechanism more precisely. Modern sovereign debt operates on a simple principle. Governments borrow by issuing bonds. Investors buy those bonds, expecting to be paid back with interest. When a bond matures, the government must either pay it off with tax revenue or issue new bonds to replace it. This is called rolling over the debt. In theory, this can continue forever. As long as investors trust that the government will pay, they'll keep buying bonds. And as long as the economy grows faster than the debt, the ratio stays manageable. But there are two hidden vulnerabilities in this system. The first is interest rate sensitivity. When interest rates rise, new bonds must offer higher yields. If a significant portion of debt is short-term and must be refinanced frequently, rising rates can rapidly increase the interest burden. This is precisely what's happening now. After a decade of near zero rates, central banks were forced to raise rates to combat inflation. Governments that became addicted to cheap borrowing are now facing massively higher refinancing costs. The second vulnerability is more fundamental. It's the assumption of perpetual growth. Debt sustainability models assume that GDP will grow forever, that the future will always be larger than the present. That productivity gains, population growth, and technological innovation will combine to generate enough surplus to service ever-expanding obligations. But this assumption is cracking. Population growth is slowing across the developed world. Europe and East Asia are aging rapidly. Working-age populations are shrinking. Dependency ratios are rising. This means fewer workers supporting more retirees, fewer taxpayers carrying more debt. Productivity growth has also stagnated. Since the 2008 financial crisis, productivity gains in most advanced economies have been well below historical trends. The easy efficiency gains have been captured. The low-hanging fruit is gone. And then there's energy. Economic growth requires energy. For 2 centuries, that energy came from cheap, abundant fossil fuels. But cheap fossil fuels are becoming harder to extract. And the transition to alternative energy sources requires massive capital investment, which must itself be financed with more debt. The growth that was supposed to outrun the debt isn't materializing, and the debt keeps compounding regardless. This is the hidden mechanism. The promise of future growth is how we justify present borrowing. When that growth doesn't arrive, the math breaks. This pattern has played out before, not in theory, in documented history. Consider Weimar Germany. After World War I, Germany was burdened with war reparations it could not afford. The Versailles Treaty demanded payments in gold-backed currency. Germany's productive capacity had been devastated. It tried to borrow. It tried to delay. But the math was impossible. So it printed. Between 1921 and 1923, the German mark hyperinflated. Prices doubled every few days. Life savings were wiped out. The middle class was destroyed. The social fabric tore apart. What followed was political extremism, the collapse of the Weimar Republic, and eventually global catastrophe. Now consider post-World War II Britain. The United Kingdom emerged from the war victorious but bankrupt. Its debt-to-GDP ratio exceeded 250%. It had borrowed massively from the United States to finance the war effort, and it could not repay. So what happened? Financial repression. For 30 years, the British government held interest rates below inflation. Savers were systematically punished. Real returns on government bonds were negative. The debt was inflated away, slowly, invisibly, without a formal default. This worked. But it required 30 years. And it required something else. Economic growth. The post-war boom, the rebuilding of Europe, the expansion of global trade. These generated enough growth to absorb the silent devaluation. We do not have those conditions today. Consider Japan. In 1990, Japan's asset bubble burst. Stock markets and real estate collapsed. The government responded with massive fiscal stimulus, roads, bridges, infrastructure, decades of borrowing. Debt to GDP climbed from 60% to over 260%. For 35 years, Japan has avoided a catastrophic collapse, but it has also avoided real growth. The economy stagnated, wages flatlined, deflation became endemic. An entire generation was lost. Japan survived, but only by sacrificing its future. And even Japan's stability rests on a single precarious fact. The Japanese public and institutions own most of the debt. It's internal. If foreigners held that debt and demanded repayment, the entire structure would shatter. Now consider Greece. During the Eurozone crisis, Greece's debt became unsustainable, but Greece could not print its way out because it didn't control its currency. The euro was controlled by the European Central Bank. So Greece faced a choice: default or austerity. It chose austerity. Pensions were slashed, public services gutted, youth unemployment exceeded 60%, suicides spiked, poverty spread, the economy contracted by over 25%, a depression worse than the American 1930s. Greece didn't escape its debt. It was crushed by it. And even after all that suffering, its debt to GDP ratio is still above 160%. These are not isolated stories. They're case studies. Each one reveals a possible path forward. Each path has costs. Here's where the analysis becomes uncomfortable. Debt-based monetary systems have beneficiaries. They're not random. They're structural. First, governments benefit. Debt allows them to spend more than they collect in taxes. It allows them to fund wars, stimulus programs, and political promises without the immediate pain of taxation. Politicians who borrow generously get to claim credit for prosperity. Politicians who push for fiscal restraint get blamed for austerity. The incentive structure rewards debt accumulation. Second, financial institutions benefit. Banks profit from debt issuance. They earn fees on bond underwriting. They earn interest on loans. They hold government bonds as collateral and leverage them for further lending. In a debt-based system, the financial sector is the circulatory system. It grows with the debt. Third, asset owners benefit. When central banks buy government debt through quantitative easing, they inject liquidity into financial markets. This inflates asset prices. Stocks rise, real estate rises. Those who own assets see their wealth increase. Those who don't own assets see their wages stagnate while the cost of housing and goods rises. This is not a conspiracy. It's a mechanism. The system channels wealth upward, not because individuals are evil, but because the incentive structure guarantees it. Consider what happened after 2008. Central banks responded to the financial crisis with unprecedented monetary stimulus. Interest rates were slashed to zero. Trillions were injected into financial markets. The goal was to prevent a depression. It worked. On paper, asset prices recovered, stock markets soared, the wealthy became wealthier. But median wages stagnated, housing became unaffordable, the middle class was hollowed out, inequality widened to levels not seen since the Gilded Age. This wasn't a side effect, it was the mechanism, and those who benefited had no incentive to change it. The price is always paid. The question is by whom? The first group that pays is savers. In a high-debt environment, interest rates must be kept low to prevent interest payments from consuming the budget. But low interest rates mean savings accounts, CDs, and bonds pay almost nothing. Savers earn below the rate of inflation. Their purchasing power erodes year after year. This is invisible taxation, financial repression by another name. The second group that pays is the young. Every dollar of government debt is a claim on future tax revenue. Today's deficits must be serviced by tomorrow's workers. Young people entering the workforce today are inheriting obligations they never agreed to. And they're inheriting them in an economy where housing is unaffordable, wage growth is weak, and the social insurance systems they're paying into may not exist when they retire. The third group that pays is the future itself. Debt-financed consumption steals from the future. Every road built on borrowed money, every war financed with bonds, every tax cut funded by deficits is a promise extracted from people who haven't yet been born. They will inherit the interest payments. They will face the austerity. They will live in the world shaped by decisions they had no voice in. This is the intergenerational transfer at the heart of the system. The present consumes, the future pays. And this brings us to the most uncomfortable question of all. What if the future cannot pay? What if the growth doesn't materialize? What if the population shrinks faster than projected? What if automation displaces workers faster than new jobs are created? What if climate change forces massive unplanned expenditures? What if the assumptions underlying every debt sustainability model are simply wrong? Then the promises break, pensions get cut, services disappear, currencies devalue, asset prices collapse, and the people who were promised security discover that the promise was never real. This isn't speculation, it's mathematics. Let me now explain the constraint that makes this situation irreversible. Governments facing unsustainable debt have historically had four options. Option 1, grow your way out. If GDP grows faster than debt, the ratio declines naturally. This is the optimal path. It requires no pain, but it requires sustained, robust growth. And for reasons we've discussed, that growth is not materializing. Demographics, productivity, and energy constraints make it unlikely to materialize. Option 2, default, refuse to pay. This eliminates the debt immediately, but it also destroys the government's ability to borrow in the future. It wipes out pension funds, insurance companies, and banks that hold the bonds. It triggers a cascade of failures. And for countries whose currency depends on confidence in their debt, it can cause total economic collapse. Default is economically rational in some cases, but it's almost never politically survivable. Option 3, austerity. Cut spending, raise taxes, run surpluses, and pay down the debt over time. This is the responsible path on paper, but in practice it causes recessions, increases unemployment, and imposes suffering on the very populations that vote. Democracies do not tolerate prolonged austerity. Governments that try it get voted out or overthrown. Option 4, inflate. Print money, devalue the currency, and erode the real value of the debt. This is the hidden default. The debt is repaid, but in currency worth less than when it was borrowed. Savers are punished. Wages lag behind prices. The middle class is quietly looted, but governments technically honor their obligations, and bondholders, while damaged, don't experience outright loss. This fourth option is the path of least resistance. It's the option that doesn't require explicit political decisions. It can happen gradually, invisibly, while officials insist everything is under control. That's why it's the option that has been chosen again and again throughout history. And that's the constraint. You cannot pay down debt that grows faster than the economy. You cannot default without triggering systemic collapse. You cannot impose austerity without political backlash. And you cannot inflate indefinitely without eventually destroying the currency. At some point, one of these options is forced upon you. And none of them are painless. Now expand this analysis globally. The United States is the world's reserve currency issuer. Approximately 60% of global foreign exchange reserves are held in dollars. Global trade, commodities, and financial markets are all denominated in dollars. This gives the United States what economists call exorbitant privilege. It can borrow in its own currency at low rates from the entire world. But this privilege comes with a hidden vulnerability. Reserve currency status depends on trust. Trust that the dollar will hold its value. Trust that the U.S. will honor its debts. Trust that the system is stable. What happens when that trust erodes? We're already seeing the early signs. Central banks are diversifying reserves. Gold purchases are at record highs. China and Russia are settling trade in alternative currencies. The BRICS nations are exploring non-dollar payment systems. None of these individually threaten the dollar, but collectively, they represent a slow erosion of monopoly. And here's the danger. If reserve status weakens, the cost of U.S. borrowing rises. If borrowing costs rise, the interest burden becomes heavier. If the interest burden becomes heavier, the debt spirals faster. If the debt spirals faster, trust erodes further. It's a feedback loop, and it can turn quickly. Consider the Eurozone. When Greece's debt crisis erupted in 2010, it didn't stay contained. It spread to Portugal, Ireland, Spain, and Italy. Because Eurozone banks held each other's debt. Because confidence was contagious. Because in a connected financial system, weakness propagates. Now imagine that dynamic at the global level. The world's major economies are all indebted. They hold each other's bonds. Their banking systems are intertwined. A crisis in one can trigger a crisis in all. And unlike 2008, there's no external rescuer, no larger economy to provide liquidity, no untapped capacity for stimulus. The rescuers are out of ammunition. When the next crisis comes, the central banks will not have room to cut rates to zero. They're barely above zero now. They will not have room for unlimited quantitative easing. Their balance sheets are already bloated. Governments will not have room for massive fiscal stimulus. They're already running deficits as far as projections extend. The buffer is gone. It's tempting to blame individuals, to point to reckless politicians, greedy bankers, or apathetic voters. But the truth is more structural than that. The debt-based monetary system was designed to grow. That's its function. Credit creation drives investment, which drives consumption, which drives employment, which drives tax revenue, which services debt, which enables more credit creation. It's a cycle, and the cycle cannot stop without collapsing. Every incentive in the system points toward expansion. Politicians win elections by spending. Central bankers avoid recessions by lowering rates. Banks profit by lending. Consumers enjoy higher living standards today in exchange for obligations tomorrow. No individual actor is irrational. Everyone is responding to the incentives they face. The tragedy is that the collective outcome is unsustainable. But no single actor can change course without suffering immediate punishment while the rest continue. This is a coordination failure, a tragedy of the commons, a system that optimizes for the short term while guaranteeing long-term collapse. And this is why the system couldn't end any other way. It was designed to expand until it couldn't. The question was never whether debt would become unsustainable. It was when. Let me bring this back to the present. We are now entering the phase where the mathematics can no longer be hidden. Interest payments in major economies are crowding out productive spending. Debt issuance is outpacing buyers. Central bank balance sheets are strained. Demographic cliffs are arriving. Productivity miracles are not materializing. Political systems are fragmenting under the pressure of inequality they cannot address. For decades, the debt could be managed through growth, low rates, and confidence. But those conditions are changing. Interest rates have risen and cannot easily return to zero without reigniting inflation. Growth projections are being revised downward. Confidence is fraying as geopolitical tensions rise and institutions lose legitimacy. The margin for error is gone. This doesn't mean collapse is imminent. It means the room for maneuvering is disappearing. It means the next recession, the next war, the next pandemic, the next financial shock will arrive in a world with no buffer. And when that happens, the options will narrow to the historical menu: default, austerity, inflation, or some combination so chaotic it rewrites the rules entirely. This is historical and educational analysis, not financial or investment advice. The patterns described here have played out over decades and centuries. Their timing is unpredictable. Their trajectory is not. Understanding history does not make anyone a prophet. It simply reveals the constraints within which events unfold. Let me leave you with this. In 1971, when the gold window closed, total global debt was approximately $1 trillion. Today, it exceeds $315 trillion. That's a 300-fold increase in 54 years. No one voted for this. No one was asked. The system simply evolved according to its internal logic. Credit created money. Money created demand. Demand created growth. Growth justified more credit. And the cycle continued until the debt became unimaginable. We are now living with the consequences of that cycle. The question is no longer whether the debt can be repaid. It cannot. The question is how the unpayable obligation will be resolved. Through slow erosion or sudden rupture, through silent inflation or explicit default, through managed decline or chaotic unraveling. History doesn't repeat, but it rhymes. And the rhyme scheme is becoming familiar. The pattern is already in motion. This channel exists to study the autopsies of systems before they repeat, to trace the mechanisms of failure so they can be understood, not predicted, but recognized. If that's the kind of analysis you value, consider subscribing. Most people won't see these patterns until the consequences are undeniable. By then, the time for understanding is past.